When the Federal Reserve cuts rates, your credit card stops bleeding and your mortgage gets cheaper, right? Not so fast. The truth is stranger, and it can save you thousands. You feel it in tiny moments. The rent renewal that jumps by $200, the credit card minimum that barely dents the balance, the car dealer smiling while a monthly payment tiptoes beyond your budget. Everyone blames rates, but here's the twist. The rate you hear on the news is not the rate you pay. It is the first domino, not the last. If you have a balance on a card, a home you want to buy, a student loan, or a small business to fund, what happens when the Federal Reserve cuts can either hand you leverage or lull you into an expensive mistake? Imagine Maya, who carries $8,000 on a credit card at an APR that makes her wince every month. Imagine Darius, who has a pre-approval for a home but keeps waiting because he heard cuts are coming. Imagine a small-town bakery planning a second oven and a second location, but the owner's line of credit is crushing cash flow. You've probably lived one of these. Here's what nobody tells you. Rate cuts help some borrowers immediately, others slowly, and a few not at all. And sometimes a cut can make the thing you want more expensive for a while. That's the knowledge gap. Your life is affected right now, yet the reason why is hidden. So let's pull back the curtain. The Federal Reserve controls the federal funds rate. The overnight price banks charge each other to borrow reserves. When the Fed cuts that rate, banks' own cost of money drops. What follows isn't a single switch, it's a plumbing system. One valve turns, pressure changes, and different pipes react at different speeds. Start with the fastest pipe, your bank's prime rate. Most banks set prime at roughly 3 percentage points above the federal funds rate. When the Fed cuts half a point, prime usually falls half a point within days. That's why your home equity line of credit, your variable rate student loan, and your small business line that says prime plus something move quickly. If your HELOC is prime plus 1, a half-point Fed cut means your rate drops half a point. Real money right there. But here's the twist. Credit cards are also tied to prime, and yet your card might not feel generous. Why? Because card rates are prime plus a giant margin based on your risk profile, and banks rarely shrink that margin. Maya's APR might be prime plus 15. If prime dips half a point, her APR dips half a point. On $8,000, that saves a few dollars a month. Not nothing, but not a miracle. And if the Fed is cutting because the economy is slowing, banks get nervous. Nervous banks raise margins, cut credit limits, and increase fees. They give with one hand and quietly take with the other. Now the part everyone asks about, mortgages. You hear cuts and your brain jumps to cheaper 30-year mortgage. But fixed mortgage rates don't obey the Fed like that. They follow the bond market, especially the 10-year Treasury and mortgage-backed securities. Those markets move on what investors think inflation and growth will be in the future. Sometimes a Fed cut lowers mortgage rates. Sometimes the cut spooks investors about inflation or financial stress. And mortgage rates rise for weeks because investors demand extra yield as a safety cushion. You can have a day where the Fed cuts and the average 30-year mortgage rate actually ticks up. That's the headline that makes people say, wait, what? And this is where things get interesting. Lenders price mortgages off two pieces, the baseline bond yield and the spread, a markup that covers risk and profit. In calm times, the spread is slim. In jittery times, like early in a cutting cycle when everyone is guessing, spreads widen. So even if the 10-year Treasury falls, a fat spread can keep your mortgage, quote, high. Darius waits for the cut, then sees his quote barely budge because the spread widened. He thinks he should wait more, but the seller raises the price because other buyers jumped in. Cheaper money met higher demand. Same monthly payment, different path. Wait, it gets stranger. Adjustable rate mortgages and many student loans price off benchmarks like SOFR, which moves with the Fed and with short-term funding costs. If you have an arm that resets every year based on S offer plus a margin, a Fed cut tends to help at the next reset. But if inflation expectations fall faster than short rates, fixed rates might drop more than your arm, flipping the math in favor of refinancing into a fixed loan earlier than you planned. The headline says cut. The smart move might be fix, zoom out for a second. Why do banks pass on some cuts quickly but not others? Banks pay you for deposits, borrow in wholesale markets, and lend to households and companies. When the Fed cuts, their cost of funds can fall. But if depositors demand high yields or move cash around, banks protect profit by being stingy on rate reductions or widening spreads. Remember the plumbing analogy. Pressure shifts, but each bank's pipes are shaped by fear, regulation, and competition. If a bank just endured a wave of deposit flight, it will not slash loan rates enthusiastically. It will guard its margins. Let's come back to the bakery. The owner's line of credit is prime plus 2. A half-point cut drops the line's rate by half a point within the month. That's immediate cash flow relief, several $100s a year on a modest balance. But the bakery also wants a 5-year fixed loan for a new oven. That rate comes from the bond market and the bank's appetite for small business risk. If the economy is wobbling, the bank might require more collateral, raise underwriting standards, or add a bigger spread. Rate cut at the top, friction at the counter. Here's what nobody tells you about timing. The Fed moves in cycles, and markets move on expectations. Often, mortgage rates fall before the first cut because investors bet the Fed will cut. The biggest decline can happen months before you read the headline. By the time the cut arrives, the market has already priced it in, and sometimes looks beyond it to the risk of a rebound in inflation. That's why Darius waiting for the cut can miss a good window. He is watching the wrong clock. The smart clock is the 10-year Treasury yield and mortgage-backed security spreads. Now, does any of this show up in your day-to-day budget? Absolutely. If you carry a credit card balance, a series of Fed cuts could shave your APR by a percentage point or two across a year. On $8,000, that might save $100 to $200 annually. Again, helpful, but not life-changing. The real win is to use that lower APR window to attack the principal harder, or to call and request a lower margin, citing your improved credit score and the falling prime rate. Yes, you can ask. Many lenders will quietly reduce your rate for loyal customers who pay on time, especially when the rate environment gives them cover. But there's a catch. During slowdowns, lenders tighten. You may see smaller credit line increases, more application denials, and higher required down payments on auto loans. Why? Risk goes up when the economy cools, so they offset any benefit of lower base rates with tougher terms. That's why some borrowers swear cuts never help them. They are right in one sense. If your credit is bruised, the margin you pay might rise exactly when the base rate falls. Two forces collide on your statement. So how do you turn this knowledge into power? Start with what moves first. If you have variable rate debt tied to prime, HELOC, small business line, certain student loans, rate cuts help quickly. Make a plan to redirect the savings to principal. You will not feel the difference if you let your spending absorb it. If you carry high-interest card debt, watch prime, but also hunt for fixed-rate balance transfer offers and low-interest personal loans. A cutting cycle is when these offers appear. Lock in a lower fixed rate while lenders are still competing for balances. For mortgages, stop waiting for a headline and start watching the bond market. Set a simple alert for the 10-year Treasury yield. When it drops meaningfully, call lenders the same week and ask for a fresh quote or a float-down option. Shop multiple lenders within a short span so credit checks count as one inquiry. If you have an adjustable rate mortgage due to reset in the next 12 months, look at the Index Plus margin and compare that to today's fixed rates. If your reset math says your rate will barely fall or could climb later, a fixed refinance might be smarter before everyone else catches on. For car loans, watch dealer behavior. When the Fed cuts, automakers often roll out promotional financing to stoke demand. but spreads can widen if lenders fear defaults. Negotiate the price of the car first, then the financing, and do not let a longer term be the only reason a payment fits. Lower base rates can tempt you into a 72 or 84-month loan that keeps you upside down longer. Lower interest with longer debt is not the same as cheaper ownership. If you run a business, plan inventory and payroll with the line of credit rate in mind. Cuts reduce interest expense on your line, but banks may tighten covenants. Keep your financial statements clean, monitor your debt service coverage, and consider fixing part of your exposure with a term loan if spreads look set to widen. The cheapest money is the money you can still access when conditions get weird. You might be wondering about savings. Do rate cuts mean your deposit yields fall? Usually, yes. Banks lower what they pay you faster than they lower what they charge you. So when a cutting cycle starts, consider moving cash you do not need for 6 to 12 months into a fixed-rate certificate before yields fall further, while keeping your emergency fund liquid. The same plumbing works in reverse here, and moving early keeps more interest in your pocket. Let's circle back to our characters. Maya calls her card issuer. She says, "Prime just dropped. My credit score is 720. Can you reduce my margin or offer a lower rate card?" She gets a 2-point reduction, small on paper, hundreds saved over a year, and she uses that breathing room to pay $200 extra each month until the balance is gone. Darius stops refreshing headlines and starts watching the 10-year yield. It dips, mortgage spreads narrow, and he locks a rate before the official cut. 2 weeks later, a rush of buyers pushes prices up, but his rate is set. The bakery owner sees the line expense fall, but instead of expanding recklessly, she secures a modest fixed loan for the oven while spreads are still tame and keeps the line for working capital. That's not luck. That's understanding the pipes. Most people think the Fed's rate is a volume knob that turns all your borrowing costs up or down together. But actually, it is the first note in a chain reaction. Short rates like prime and SOFR follow quickly. Fixed loan rates listen to the bond market and to investor nerves. Lenders can blunt or amplify the cut through spreads, fees, and underwriting. Demand can surge and lift prices, offsetting the benefit. And your personal credit profile sits on top of all of it like a magnifying glass, making the sun warmer or burning a hole. So the power move is simple and rare. Know which of your debts are variable and which are fixed. Know which index each one listens to. Track the 10-year treasury for mortgages and the prime rate for lines and cards. Ask for better terms when the environment gives you leverage. Decide whether to lock before the crowd and use any reduction in interest to shrink the principal while the window is open. Why does this matter today? Because every cycle creates winners and losers among borrowers, not by luck, but by awareness. The Fed will cut. Not every borrower will benefit. You will, because you finally see the mechanism beneath the headline. Money moves through pipes. You know where the valves are. And the next time someone says rates are down, so you should wait, you will smile, check the right clock, and make the move that saves you real dollars right now.